Hello there, Turkey enthusiasts. This is Atilla Yeşilada reaching out to you from a rainy Istanbul morning, or actually midnight. It's about 2 a.m. That's when I do my best work, just recovering from my nightmares, which gave me cold sweats and forced me to get out of my bed screaming. This is what happens when you live in Turkey and deal with Turkish politics. Really, just an ordinary experience that every Turkish citizen suffers every night. Today we're going to talk about Turkey's impending and inevitable interest rate hikes. And let me show you our cover page, just a second here. Today's video is titled, Turkey Must Hike Rates After Elections, Who Will Get Spanked Bad? I would have said screwed badly, but I suppose there are minors watching this video. I don't know why, but just wanted to keep it as clean as possible, though really spanked is as polite as I get. If you live in the Eurozone, essentially in the United States, if you live anywhere outside Japan, Turkey, and China, your central bank is raising interest rates and you are feeling the effects. Financing, credit card financing becomes harder to come by. Home prices decline. You can't really get a mortgage even if you have a decent credit score. Life in general becomes very miserable. Nevertheless, in Turkey's case, these are inevitable simply because Turkey's inflation is at about 50% if official data is to be believed. And let me give you a hint, it is not to be believed. Real inflation is roughly about 70%. And it's not going to get better, it's going to get worse. I'll tell you why. Whereas the central bank's policy rate, the main interest rate that determines all the other rates, is only 8.5%. Obviously, this picture is very wrong in the sense that, Erdogan's policy of fighting inflation by lowering interest rates is unique on this planet, and I believe also on Venus and Mars, in the sense that most decent people believe that to fight inflation, the first thing, not the only thing, but the first thing that the government needs to do is allow the central bank to hike rates. There is a consensus among experts and investors who have been largely absent from Turkey simply because our interest rates are too low, that massive rate hikes are inevitable. As you know, we face elections on May 14, where both the presidency and the parliament will be up for grabs. I've shot 2 videos recently. I firmly believe the opposition candidate Kemal Kilicdaroglu will be Turkey's next president. And his political entity, the National Alliance, probably will have a working majority in the Grand Assembly, our parliament. Judging on its common documents, election manifestos, we know Kilicdaroglu and the National Alliance will immediately normalize monetary policy, which means adopting the policy stance that the rest of the world does, which is you fight inflation by rate hikes and other things as well. If Erdogan remains in power, which he might if he resorts to cheating and other institutions let him get away with it, he won't raise rates until we're at the very brink of a currency crisis. Then I think the old pragmatic Erdogan will return, and instead of going down in flames with a balance of payments crisis, he'll allow the central bank to raise rates. One way or other, we're going to have higher rates. And I mean, if you live in the United States, Fed started hiking rates about 14 months ago and started from zero or very low and hiked up to 4.75%. Probably the fastest rate hike cycle since 1970s, I believe, but 0 to 5%. In Turkey, it will have to go from 8.5 to 40%. We'll see in the video. And that's a drastic change in the operating environment for the government, for corporations, and for households. So the question of who's going to get burned is very valid. Everybody will, but to different degrees. I'm going to motivate that part of the video mostly through the lens of banks because they provide financing to everyone. And if you can prove that rate hikes will severely jeopardize banks' ability to issue loans, and if they do so, their loan rates will go up increasingly, you make the point that though absolutely necessary, interest rate hikes do impose massive costs on every segment of the society. So let's take a look at how this debate started. Here we go. This is an article from Bloomberg. Wall Street forecasts big rate hikes in Turkey after elections. It was published about a week ago and made headlines in Turkey. In this article, Wall Street journalists interviewed several economists and major investors who monitor Turkey or who are active in Turkey. And well, there was a consensus that rates will need to go higher, though there was some suspicion as to whether Kilicdaroglu will win and when Mr. Erdogan might be forced to increase rates. But if you read the article, Bloomberg polls economists and strategists every quarter about Turkey's interest rates. In a month, the average expected interest rate rose from 8.5% to 22.5% as of the third quarter of 2023. That's when a new government will take power in Turkey. And if you read the article, you would see reliable experts on Turkey, such as Citibank, where a friend of mine, İlker Domaç, is a Turkey economist, expect rates to go up to 40%. Let's look at another article here. This is by, Institute of International Finance, which just published its trip notes to Turkey. It thinks, again, like those who were interviewed by Bloomberg, that rate hikes cannot be avoided, that somehow they'll get done this year. And its forecast is that as part of the anticipated post-election monetary policy normalization, many local analysts expect to see the policy interest rate, currently at 8.5%, converge towards the weighted average deposit rates, the range of which is 25 to 30%. What do I think? Well, there are two approaches to fighting inflation with monetary policy. Once again, I need to say this, just monetary policy is an extremely costly way of fighting inflation. You have to take other measures such as fiscal rectitude, such as increasing credibility, issuing long-term plans to explain to the people how you intend to fight inflation, do changes to the indexing of wages and salaries to past inflation, and of course a structural overhaul of the Turkish economy so that for any given increment of increase in GDP, it produces less inflation. But let's leave those aside for the time being, assuming Erdogan will do none of those and Kilicdaroglu some of those, though not all of them. There are two approaches to fighting inflation. The first is the front-loaded approach or the hammer approach, which is whatever the central bank's forecast of inflation is, or even better, whatever the headline inflation is, you set the policy rate substantially above that, which immediately wreaks havoc in economic activity. In Turkey's example, if the going rate is 50%, and I think even though a lot of analysts will tell you Turkish inflation will go down to 25% in 2024, I don't believe that. We have the earthquake damage to pay for, which also reduced our capacity to produce, so a lower supply, higher demand, higher inflation. This has been a very costly election race. Pork barreling has been rampant. Let's give credit to Erdogan. In the past elections, he didn't really spend too much or promise to spend too much simply because he was so confident of victory and didn't really need to bribe the voters. This time he's fighting for his life, so he opened the floodgates to fiscal stimulus. It's difficult to come up with an estimate of how much these are going to cost. But again, according to this IIF article, Institute of International Finance, the federal budget deficit, which is currently running at 2.5% of GDP, might widen to 6% by the end of the year. The team I work with were at around 4 to 5%, but it's going to be sustained. So, very high budget deficits equivalent to 3% of GDP on top of what we have right now. The second approach is the gradualist approach, which is to raise rates incrementally so that the pain will be less at each instance, but you do so over a long period of time. And in the meantime, you assure all actors in the economy that rate hikes will not stop until inflation converges to the central bank target rate, which in Turkey is 5%. Now, obviously, if I were a central banker and I wasn't afraid of being lynched by the public, I would go for the front loaded approach. Just take the hammer to inflation and then deal with the damage later. But I don't think that's going to happen in Turkey, simply because we have another elections in March 2024, local elections, which are as critical as presidential or parliamentary elections. So I think IF's forecast, even though slightly optimistic, is right in the ballpark. Currently, the marginal interest deposit rate paid to high net worth individuals is roughly 35%. That's a good opening move by the new central bank. Rates will have to be hiked to 35, hopefully to be more effective to 40%. And then a promise will be made that if inflation doesn't decline, as measured in each subsequent quarter, monetary tightening will continue. Will Erdogan increase rates if he remains president, to which I assign at most 20% probability? He won't. He is dead set against higher interest rates, both as a matter of his religious belief. He thinks interest rates are usury. Secondly, simply because he believes in growth and he doesn't think inflation is such a big problem or a temporary problem. So he won't voluntarily do so. But as I've suggested in several videos below, Turkey is very close to a currency crisis in the sense that our currency outflows in terms of trade and financial account are much bigger than our inflows, again, from trade and tourism. And that's an unsustainable situation. Central bank reserves are already minus a negative $50 billion, which means the central bank is covering Turkey's hard currency needs by borrowing from banks. So essentially, central bank sucks up all the hard currency savings in the country and sends them abroad to make ends meet. And as you know, if you spend more than your income, you start eating into your wealth, and unless you are Mr. Elon Musk or Jeff Bezos, at some point your wealth runs out and you are bankrupt. And that's how the central bank policy will end. In the summer, there won't be much of a pressure to raise interest rates simply because tourist flows, the typical tourism season generates $50 billion across the year, but most of it accruing in the summer months. So currency pressures will be relatively subdued. But once tourists leave in around October and the energy bill comes knocking at your door, then you have to do something. That's the point at which Mr. Erdogan would face the disaster of a currency crisis and will be forced to raise interest rates. The National Alliance, the candidate of which is Kemal Kilicdaroglu, is very clear on that. They're immediately going to go back to normal monetary policy and appoint an independent guy or gal who will raise interest rates. So let's go to the damage. And again, everybody will get hurt. If you bought a house at inflated prices, you will see the equity in your house decline. If you have a lot of credit card debt, or if you have taken consumer loans, this will be repriced at a much higher rate, etc., etc. But a good starting point of how interest rate hikes reverberate through the economy is to look at it from the lens of the banks, simply because they do all the credit transactions. And here, the ultimate authority, I suppose, is Professor Hakan Kara, who is currently an academician, but he used to be the research head of Turkish Central Bank. And in a recent statement, he said rate hikes will jeopardize banks' capital adequacy. He did his own stress tests on banks to come up with the conclusion that the current capital to asset ratio of banks, which are at about 18%, will be reduced to roughly 12% under certain assumptions such as rate hikes, a higher non-performing loan ratio, and a small currency shock, all of which are fairly reasonable. You can argue with that and this, but it doesn't matter. At the end, you have to make assumptions, and these are relatively reasonable. Now, even if the bank's capital adequacy ratio declines from 18 to 12%, they are solvent. In fact, they are considered well capitalized according to BIS norms. But in Turkey, this is sort of the bare minimum of how much capital a bank needs to hold against contingencies, which means A, even if they're profitable, banks won't be able to pay out dividends for years to come. B, either they will stop most of their lending activity to accumulate more capital, or they'll have to tap the shareholders with paid equity increase, which is always costly. I would think they'll go for a combination of both, but in any case, loan rates will rise substantially if the central bank policy rate is 40%, and if you're collecting deposits at 35%, your prime loan rate will be no less than 45%. And for a guy with an average credit score, Attila Yeşilar, it will be something like 50%. Hakan Kara is not the only one who thinks Turkish banks are highly uh, under stress if the rate hikes do take place. This is S&P Global Ratings, and the article in Reuters says Turkey, Tunisia banks most at risk for tighter financing conditions. Essentially, S&P Global argues that Turkish balance sheets have been weakened because of the silly interest rate and macroprudential policies of the Erdogan government. And if the international environment changes to the point where countries like Turkey, which are emerging markets with low credit ratings, are shut off from global loan markets, they will suffer losses. And of course, to deal with that, you have to accumulate more profits and reduce your reliance on foreign loans, which means, repricing your loans and collecting loans so that you have not only a capital adequacy, capital buffer, but also liquidity buffer. More importantly, the higher a bank's capital to asset ratio and liquidity and profitability, the lower the rates at which it borrows from abroad, and the better access it has to international credit markets. So once again, just like Hakan Kara, S&P Global essentially says, look, things are going very tough. They are going to get worse, and banks will need to do something. And that something, increasing capital adequacy, increasing liquidity, increasing profitability, means that they will spread the pain through the other sectors of the economic community. Those who are severely at risk are homeowners and mortgage borrowers. In Turkey, all mortgages are at fixed rates, so in that sense, they will not be faced with higher financing costs. But the price of homes will decline, as it happens everywhere when there is a sustained monetary tightening episode. So they will have less equity in their homes if they are forced to sell, or if they had bought the house not as a place of residence, but as an investment, they'll suffer losses. And of course, they'll have to cut their consumption. But most at risk are corporations. Most of them have been operating in a negative interest rate environment for the last 3 years, as a result of which, as anywhere in the world, they have loaded up on leverage. Their uh, debt to GDP ratio, debt to equity ratios have increased substantially and they have become less profitable. A lot of them will go bankrupt. A lot of them, to pay off their loans, will have to cut production, will have to raise prices, and let go of people. That's painful. The whole issue of corporate bankruptcies looms large on the horizon of the entire global economy. Because of the pandemic, we have allowed numerous zombie companies to survive for this long. But now that the global environment has changed, every government must devise a plan how to put these zombies humanely to bed so that young and profitable companies can have access to finance and grow faster. It's no different in Turkey. Of course, in Turkey, the pain, when it's addressed, will be much bigger simply because Turkey is a small company heaven. We have very few large conglomerates at the top, which account for 50% of the GDP. They'll be safe, but there are millions of smaller companies at the bottom which sell to the local market or act as suppliers to these larger companies, which really have very weak balance sheets and they'll suffer very badly. Consumers, too, Turkish consumers are not heavily leveraged, but again, when you borrow at rates of 20 to 25% on your credit card or on your car loan, when inflation is 50%, you also indulge in overspending and overborrowing. And more importantly, or more devastatingly, for most of us, these loans have become part of our income statement. We don't really intend to pay them off. We plan to roll them over when they mature, so have a constant ratio of leverage in our balance sheet. But that assumption cannot be held valid if rates are increasing very rapidly and if banks are curtailing access to credit by low score consumers. So some of them will have to pay it off immediately, and many, probably as many as 2 million, will have to do with bankruptcies and Chapter 11 negotiations. So it's a highly messy situation. Of course, the budget too will suffer. Turkey's domestic debt stock is 75% at fixed rates, but the average rate on government bonds is less than 15%. So even though just a small portion of debt will come due each year, which will ease the additional burden on the budget in the first year of monetary tightenings, assuming the monetary tightening will continue roughly 3 years or so, each year interest rate expenditures in the budget will increase faster than the year before. Since you really can't raise taxes that much, no government can in a democratic country, it simply means saving on other spending items. And unfortunately, these happen to be discretionary spending, social welfare, education, infrastructure, health, etc., etc. It's a messy situation, but it's inevitable. It must be done for the overall safety and health of the Turkish economy. And essentially, Mr. Erdogan got us into this situation. He will retire, and the new government and the entire nation will have to deal with this mess. And it will take about 3 years to clear it up. But believe me, everything is better than a balance of payments crisis, which would happen if Erdogan were to stay in power and not raise interest rates. Probably a little bit technical and a little bit long winded, but I wanted to um, kill two birds with one stone. A, wanted to explain why post-election Turkey will have to increase interest rates. B, I wanted to briefly cover the issue which I promised for long, that Turkish banks are solvent, they are liquid, but their profitability will suffer, and probably most of them will have to raise capital in the coming years. Thank you very much for watching another broadcast of Real Turkey channel. This is Atilla Yeşilada saying goodbye and stay safe from Istanbul.